Good afternoon. My name is Robert Mizey, and welcome to my continuing series on the International Tax Provisions of the Internal Revenue Code. Today we talk about checkups for ICDISC. What you don't know may hurt you. And look, I don't want to scare people, but here's the horror story that prompted me to create this short video. I've done a lot of ICDISC over the years, and I'm sure many of you have done ICDISC, or maybe you have clients who've done ICDISC. And there are very simple yet rigid rules that have to be followed to get the export benefits. So I was talking to an accountant who had referred me an ICDISC, and the accountant told me, the client got audited, and as a result of the audit, they lost their tax savings of about $60,000 for each of the last 3 years. And the whole problem was that the client had commingled its ICDISC cash with the main exporter's cash account. As a result, they didn't satisfy the separate books and records, and they didn't have it didn't look like the client had 95% of its assets constituted qualified export assets. But let's very briefly go through the rules. First, 95% of your assets have to be qualified export assets, and 95% of your receipts have to be qualified export receipts. If you're a very simple, easy in, easy out ICDISC, these are no problem to handle. You should be able to satisfy those very easily. Another requirement, the $2,500 par value requirement, should be able to simply be handled by way of stating in the Articles of Incorporation, par value $2,500. The agents don't see it that way. They want to see a checking account. And don't put $2,500 in, put $3,000 in, because you never know if there's going to be a service charge. Remember, you can only have sales of export property. Export property is property that's manufactured in the United States, sold for use outside the United States, and is no more than 50% foreign content. Finally, you don't want to be too aggressive with your expense allocations. If you're doing the 50% of combined taxable income method, the IRS is all over aggressive allocations of expenses to domestic sales. They see that domestic sales have a net operating margin of 2%, but export sales have a net operating margin of 16%. They're going to think something is up. At the same time, if you had an ICDISC for a while, maybe it's time to reconsider the structure that you currently have. This diagram depicts the very simple structure of an easy in, easy out ICDISC. We have U.S. individual owning an S corporation that exports and therefore has a sub as an ICDISC. The S corporation pays the commission the ICDISC and receives the dividend. Well, there are a lot of new structuring techniques that you can use. And maybe this structure, which might have been great 10 years ago, may not work or may not be as tax efficient right now. For example, you want to use it for compensation. Maybe there's a highly valued employee you might want who wants a piece of the action. You don't have to give them a piece of the action of the S corp, but you can give them a piece of the ICDISC to compensate them. For succession planning, how do you plan on the next generation taking over the business? Maybe you want them to have part of the ICDISC to get them vested in what's going on, so there's buy-in with respect to succession. Then finally, retirement planning. Although I was very reluctant to advocate use of holding an ICDISC through a Roth IRA, there are 2 circuit court opinions in the last couple of years endorsing this idea. As a result, I think that if you're an entrepreneur in your 40s or maybe even early 50s who plans on being around for a while, I think the Roth IRA idea might be a great way to accumulate value in your Roth IRA via the ICDISC. That can help with your retirement planning. Well, thank you for joining me. I look forward to seeing you next time when we talk more about international taxation. Have a great day.